The IRS is not going to call you and say, "Hey, you're overpaying us. Want your money back." They're not doing that. Your employer's not doing that. Your bank definitely isn't doing that. So what ends up happening? Regular families, people making $60,000, $80,000, $120,000 a year. You're playing the game exactly how you were told and still losing. Meanwhile, there are families making the same income, not millionaires, not billionaires, just informed, and they're legally paying thousands less every single year. Same country, same tax code, completely different outcome. And the reason I'm making this video right now, specifically right now, is because in 2026, after the One Big Beautiful Bill Act changes kicked in, the gap just got wider. New deductions, bigger write-offs, more ways to shield income. But nobody's explaining it in plain English. So by the end of this video, you're going to know exactly how to legally reduce your taxable income, stack deductions, and potentially keep thousands more dollars in your household without doing anything shady. Hey, I'm Brian, and I spend way too much time thinking about how the system actually works, not how we're told it works. And real quick, if you care about keeping more of what you earn, hit subscribe. Think of this channel like peer review for your money decisions. Highest ROI you'll get in 10 minutes a week. Because this stuff, it has a window, and most people don't realize it until it's already closed. So let's start with the one almost nobody is fully using. Trick number 1, that you don't owe yet, shield. This one sounds boring. It's not. It's the foundation of everything. And it just got supercharged. Most people hear standard deduction and immediately tune out because for years it was fine, nothing special, just a default option. But after the recent changes, this is now one of the biggest tax shields available to middle-class families, and most people are still treating it like background noise. Here's how it works in plain English. Before the IRS even starts calculating what you owe, they let you subtract a chunk of your income completely tax-free. For married couples in 2026, that number is now $32,200. Meaning, if your household makes $90,000, the IRS is only looking at about $57,800 as taxable. But here's where it gets interesting. If you or your spouse are 65 or older, there's an additional $6,000 per person. So, a retired couple? They could be shielding up to $44,200, even $47,500 depending on the structure. That's nearly half of a $100K income just invisible to taxes. Now, let's run real numbers. Let's say you and your spouse make $100,000 combined. Right off the top, $32,200 is gone, not taxed. You're now down to $67,800. If you're in roughly the 12% federal bracket, that deduction alone just saved you about $3,800 in federal taxes. $3,800. That's not a coupon. That's not we saved a little bit at the grocery store. That's a used car. That's a year of groceries. That's breathing room. And yet here's the mistake people make. They ignore this number and focus only on what they earn, not what actually gets taxed. Rich families don't do that. They obsess over the gap between income and taxable income because that gap is where the game is won. And this deduction? It's step 1 in widening that gap as much as legally possible. You don't start by making more money. You start by making more of your money untouchable. If you're new here and just subscribed, comment your name below. I read every comment and shout out new subscribers in my next video. I do appreciate you joining me on this finance journey. Trick number 2, the work more, keep more rule. This one is brand new, and almost nobody is using it yet because it sounds too good to be true. For years, you've probably felt this. You work overtime, pick up extra shifts, grind harder, and then payday hits, and it feels like half of it just disappears. Like you ran on a treadmill, and the IRS was standing at the end collecting a toll. That frustration? That was real. But now there's a shift. Under the new rules, there are 2 separate deductions that just opened up. First, if you work in one of the 68 IRS-approved tipped occupations, think servers, bartenders, hotel staff, you can deduct up to $25,000 of your tips from your taxable income. Second, overtime pay. If you're earning overtime, There's now a deduction of up to $25,000 for married couples, $12,500 if you're single, specifically on that overtime premium. Not your base salary, just the extra you earn for going beyond. Now let's make this real. Say you're a nurse making $80,000 a year. Out of that, maybe $15,000 came from overtime shifts. Before, that full $15,000 was taxed like normal income. Now, you may be able to deduct that entire $15,000. So if you're in that same 12% bracket, that's about $1,800 back in your pocket, just for structuring your income the right way. Or let's say you're a server making $60,000 total with $20,000 in tips. If you qualify, that $20,000 could be deducted. That's another to $2,400 saved. Here's the catch, because there's always one. You have to be in a qualifying occupation for tips. And for overtime, it has to be documented properly, meaning your pay stubs and W-2 need to clearly separate base pay from overtime premiums. Most people miss this because they assume income is income. Rich families don't think like that. They break income into categories because different categories get taxed differently. Same effort, same hours. But one person gets taxed fully, the other legally slices off a chunk and keeps more. That's not luck. That's awareness. And when you stack this on top of what we just talked about, that standard deduction, you're starting to see the pattern. It's not about working harder. It's about making sure the extra work actually stays in your house. Because $2,000 here, $1,800 there, that's real money. That's a vacation you don't have to put on a credit card. That's margin. And we're just getting started. Trick number 3, the stack the system move. This is where most middle-class families leave the most money on the table, not because they don't qualify, but because they don't realize these things can be layered. They think it's either this credit or that one. No, it's both. And then some. There are 3 major pieces here, and together, they hit way harder than people expect. First, the child tax credit. It's now up to $2,200 per child. Second, the dependent care credit. This one got a massive boost, covering up to 50% of your qualifying childcare expenses. Third, the dependent care FSA. This is pre-tax money you can set aside through your employer, now up to $7,500. And here's the key idea. These don't cancel each other out. They stack. Let's walk through a real household. Say you've got 2 kids. Right there, that's up to $4,400 in child tax credits. Now let's say you spend $8,000 a year on childcare. At a 50% credit rate, that's another $4,000 back. We're already at $8,400. Now layer in the FSA. If you set aside $7,500 pre-tax, and you're in that same 12% bracket, that's about $900 in tax savings. So now we're looking at roughly $9,300 in total benefit. $9,300. That's not a little help. That's the difference between staying stuck and actually getting ahead. But here's where people mess this up. There are income phase-outs, meaning once your household income gets too high, these benefits start shrinking. For many families, that phase-out starts around the low to mid 6 figures. So if you're earning between $50,000 and $150,000, you're right in the sweet spot. And the second mistake? They don't file the right forms or track expenses properly. Childcare receipts, employer FSA elections, making sure everything lines up. It's not complicated, but it does require intention. Think of it like a gym membership. You can have access, but if you don't show up, nothing changes. Rich families show up. They track. They plan. They stack. Because they understand something most people miss. The tax code isn't just a bill. It's a reward system. And if you're raising kids, paying for care, working, and contributing, there is money sitting there with your name on it. You just have to actually claim it. Because $9,000? That's not abstract. That's rent. That's tuition. That's a financial reset. And most families never even realize they were eligible. Trick number 4, the drive it, deduct it move. This one flies completely under the radar, because for years, buying a car was just an expense. No upside, just a monthly payment and a slow bleed. But now, There's a way to turn that same purchase into a tax advantage if you do it right. Here's what changed. If you finance a new U.S. assembled vehicle after December 31st, 2024, you may be able to deduct up to $10,000 per year in auto loan interest. Not the full payment, just the interest portion. Still, that's the part most people never see working for them. Now let's break it down. Say you buy a $35,000 vehicle and your loan results in about $6,000 of interest paid in a year, which isn't crazy depending on rates. That's $6,000, potentially deductible. If you're sitting in that 12% tax bracket again, that's about $720 back in your pocket. Same car, same payment, but now the government is effectively discounting your interest. That's like getting a partial rebate on something you were already going to do. Now, here's where people mess this up. First, it has to be a qualifying vehicle. New, U.S. assembled, and the loan has to be initiated after that cutoff date. Second, there are income limits. If your household income climbs too high, this deduction starts phasing out. So again, that $50,000 to $150,000 range, that's the zone where this actually hits. And third, documentation. Your lender will typically issue a statement showing how much interest you paid. You need that. Because if you don't claim it, it doesn't exist. And let's be real for a second. Most people treat cars like a lifestyle decision. Rich families treat them like a financial decision with tax consequences. Same road, same traffic. One person's just commuting, the other one's quietly shaving hundreds off their tax bill while doing it. And when you stack this with everything we've already covered, now your everyday life, your job, your kids, even your car, is starting to work in your favor. That's the shift. Trick number 5, the pay yourself, not the IRS system. This is the one rich families build their entire strategy around. Because instead of trying to reduce taxes after the fact, they prevent the taxes from happening in the first place. Here's how. Retirement accounts, specifically 401(k), S, and IRAs, let you contribute money before it gets taxed, meaning you lower your taxable income right now while building wealth for later. In 2026, the numbers are bigger than most people realize. You can contribute up to $24,500 into a 401(k) and another $7,500 into an IRA. That's $32,000 total. Now think about what we said earlier. The game is the gap between what you earn and what gets taxed. This is how you blow that gap wide open. Let's run the math. Say you make $100,000. If you contribute $20,000 into your 401(k), your taxable income drops to $80,000. At a 12% rate, that's about $2,400 in tax savings immediately. But it gets better. There's something called the saver's credit, and almost nobody talks about it. Depending on your income, you can get a credit of up to 50% of what you contribute, capped at certain limits. So let's say you qualify for a 20% credit and you contribute $5,000. That's another $1,000 directly off your tax bill. Not a deduction, a credit. That's dollar for dollar. So now you've got $2,400 saved from reducing taxable income, plus another $1,000 from the credit. That's $3,400 in total impact for doing something you should already be doing anyway. Now, a couple key details. There are income thresholds for the saver's credit. If you earn too much, it phases out. And for IRAs, there are rules about whether your contributions are deductible depending on your workplace plan. Translation? You don't just throw money in randomly. You structure it. Rich families don't ask, how much can we afford to save? They ask, how much can we move out of the IRS's reach this year? Because every dollar you redirect into these accounts is like taking it off the chessboard before the game even starts. The IRS can't tax what it doesn't see as income. And when you combine this with the standard deduction, the credits, the overtime deductions, you start to realize something. This isn't one trick. It's a system. And if you use it right, you're not just saving a few $100s. You're redesigning how your entire income gets treated. And that changes everything. And because I always give you one more. Bonus trick: the give and get paid back move. This one is simple, almost too simple, which is exactly why people ignore it. You no longer have to itemize your deductions to get a tax break for giving. Meaning, even if you take the standard deduction, which most people do, you can still deduct up to $1,000 if you're single or $2,000 if you're married in cash, charitable donations. Above the line. That's the key phrase. It reduces your taxable income directly. Now, let's make it real. Say you and your spouse donate $2,000 across the year. Church, nonprofits, community support, whatever matters to you. At a 12% tax rate, that's about $240 back. Not massive, but not nothing. And here's the mindset shift. You were probably going to give anyway. Now you're just being intentional about how you document it. That means receipts, bank records, making sure it's a qualified organization. Because if you don't track it, it's invisible. And invisible doesn't get rewarded. This is like finding $240 in your winter jacket pocket. Small compared to the other strategies, but it counts. And when you stack it, it matters more than you think. Let's zoom out for a second. Because individually, these sound like little moves. A few thousand here, a few hundred there. But this is exactly how rich families think differently. They don't look for one big win. They stack 5, 6, 7 smaller advantages, and suddenly the outcome is completely different. So, let's put it all together. Let's say you're a married couple making $100,000. Right off the top, that standard deduction wipes out $32,200. Now you're down to $67,800. You contribute $20,000 into your 401 KEK. Now you're at $47,800. You've got 2 kids, that's $4,400 in child tax credits. You spend on childcare another $4,000 in credits. You use the FSA, save about $900. One of you works overtime, that knocks off another $1,800 in taxes. You financed a car, that's another $700 or so saved. You donate, pick up another $240. Add in the saver's credit, let's say $1,000. When you stack all of that together, you're looking at well over $10,000 in total tax impact. Over $10,000. That is not a rounding error. That is a completely different financial reality. That's the difference between carrying credit card debt or wiping it out. Between, we can't afford it, and we actually have options. Same $100K income, but one family pays full price, and the other one uses the system the way it was designed. That's the gap. Now, here's the part nobody tells you. Most of these strategies, they're temporary. A lot of these expanded deductions and credits are scheduled to run through 2028, and then they're set to scale back or disappear if nothing changes. So this isn't something you get to eventually. This is a window, and the people who move during the window win. Also, let's be very clear. None of this is shady. This is not loopholes for billionaires hiding money offshore. This is the tax code, exactly as Congress wrote it, being used the way it was intended. But your employer isn't going to explain this to you. The IRS isn't going to remind you. Your bank? They make money when you don't have extra cash. So the responsibility falls on you, which is why I make these videos. So real talk, drop a comment, and tell me which one of these you didn't know about. Because that right there, that's where your money's been leaking. And if you want more breakdowns like this, hit subscribe. We put out videos every week showing you how to actually use the system, not just survive it. And share this with your family, your coworkers, anyone who's working hard but feels like they're not getting ahead. Because the truth is, it's not just about how much you make. It's about how much you keep. And most people were never taught how to play that game.